Hello and welcome to Earnings Echo. We put together the most important information about Lemonade.
Right. And can an algorithm actually beat a 100-year-old insurance company at its own game?
Today, Lemonade's Q1 numbers might just prove it can, but there is a serious catch hidden in the math.
Yeah, we are cutting through the noise in this deep dive to show you exactly what is driving their massive valuation.
Let's jump right into the hard facts.
Well, Q1 revenue hit $258 million, which is, a massive 71% year-over-year increase.
Right.
And in-force premium, which represents the total annualized value of all their active policies, essentially a measure of their true customer footprint, reached $1.33 billion.
Up 32%, right.
Right.
And net loss narrowed to negative $35.8 million.
Or a loss of 47 cents per share.
Those figures easily beat consensus. Management even raised their full-year guidance, aiming for an in-force premium midpoint of $1.63 billion.
Unsurprisingly, the market reaction has been aggressively bullish. They are now trading at a $5.22 billion valuation.
But wait, their revenue grew 71%, more than twice as fast as their actual premium footprint. I mean, that math feels broken.
Yeah.
What is the catch here?
It is basically an accounting quirk tied to their reinsurance.
Yes.
So Lemonade used to hand over 55% of their premiums and the associated risk to bigger backup insurers.
Okay, got it.
They have stepped that giveaway down to a normalized 20%. So recognized revenue looks like it is exploding.
Yeah.
But it is really just Lemonade keeping a bigger slice of the pie they were already baking.
Got it. So it is like taking off the training wheels.
Yeah.
The revenue surge is a structural mechanic, not a sudden flood of new customers.
Exactly.
If we strip that away, where is the actual operational growth coming from?
Well, pet insurance is the bedrock right now, surpassing $500 million in force premium.
Right.
But car insurance is the real accelerant here, compounding at a 60% year-over-year growth rate in Q1.
Okay, the growth is definitely there. But gross profit surged 159%. In the insurance business, margins are notoriously razor-thin.
Yeah, they really are.
How exactly are they pulling off that level of efficiency?
That stems directly from their AI-driven automation. Their loss adjustment expense, or LAE ratio, dropped to an industry-leading 6%.
Wow. So legacy insurers can only dream of that.
Exactly. That means for every dollar of premium, they are only spending 6 cents to process and settle claims.
Right.
Furthermore, their premium per employee just crossed the $1 million threshold. Headcount only grew 2% while driving a 32% increase in business.
Meaning bots are doing the heavy lifting, approving claims in seconds, rather than human adjusters taking weeks. That is serious operational leverage.
Right, and management's tone on the earnings call reflected that leverage. They sounded highly confident, explicitly reiterating their target for their first positive adjusted EBITDA quarter in Q4 2026.
Which brings us to the $5.22 billion question valuation.
Yes, the valuation.
We ran a reverse discounted cash flow model. To translate that for you, it's basically reverse engineering the math to see exactly what future expectations are baked into today's stock price.
It is not an exact science, but it acts as a very reliable indicator of market assumptions.
Right.
Because Lemonade is pre-profit, we applied a revenue-based approach modeling a margin ramp.
Right.
At this current valuation, the market implies a demanding 21.3% revenue compound annual growth rate over the next 10 years.
It's steep.
It is. Crucially, it also requires them to expand their net income margin from the current negative 4% to a 12% terminal margin.
And there's the critical vulnerability for you to consider. Mature, tech-enabled insurers usually top out at an 8 to 10% terminal margin.
Right.
If Lemonade only hits an incumbent like 10% instead of 12%, the required revenue growth to justify the current stock price jumps to 24%.
Yeah.
That leaves absolutely zero room for error in their execution.
Summarizing the Echo takeaway for you today, Lemonade's AI scalability is undeniably proving out in their unit economics. Keeping claim processing costs at 6 cents on the dollar is phenomenal.
Definitely.
However, the premium valuation demands flawless execution. They must sustain hypergrowth in the car and pet segments to hit that elusive 12% margin.
Which leaves you with a final thought to mull over. Can an insurtech structurally break the traditional margin ceiling using artificial intelligence?
Right.
Or is the market pricing in a level of operational perfection that the basic physics of insurance simply will not allow?
Time will tell if the algorithm can truly beat the house.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.